Okay, so the simple description part one is that we get the data from S&P 500 call options from CBOE and ranging from 1996 to 2005. And the call options maturities is from 10 to 180 days. And we will exclude the two extremes, which is under 10 days or over 180 days, because we want to use a mid-course to mitigate the bid-ask bounce bias. So the simple description part two is that we use risk-free rate 3-month treasury bills from data stream. And the stock and dividends CRSP data ranging from 1990 to 2005. And money is in the money, S minus K divided by K greater than or equal to 0.03. Meaning that stock price minus strike price divided by strike price is bigger than this. Meaning stock price is greater than K strike price by about at least 3%. Conversely, out of money is smaller than minus 0.03. In the money, okay, market momentum is about 60-day cumulative return, the return in the market. So we categorize the market momentum. I have just said that market momentum will impact the model's forecasting accuracy. So we categorize the market momentum by 5 categories. From the minus returning market, smaller minus, until returning market is bigger or equal to 10%. This is a downward market. This is upward market. And as I have introduced the egarch family, but there are 2 major players here. One is egarch, another is egarch. Why is that egarch has always can capture the stable and upward market? Then it's apparently why. Because the positive and negative shock epsilon, you square it, then you always be bigger than 0. You can catch in its magnitude like this one. So it can capture the symmetry and capture the stable market value. But for this egarch model, it always can capture the volatility or bad news well. Why is that? Because this term in this formula, this gamma 1 is smaller than 0, and epsilon t minus 1 meaning what? If it's smaller than 0, meaning that there's bad news. If there's bad news happen, and minus times minus, then it will be greater than 0. And then log variance will be very big. The variance will turn out to be very big. So there's a leverage effect. When there's a negative effect, the variance will become very big. So egarch is very simple, but it can capture. This is a simplified version. It can capture the negative effect. And also with the egarch models, how do we evaluate this egarch model? In different business conditions and market momentums, we use this MNE and IDR and SC. Mean absolute error, and this one. The smaller, the better. We can find out that, see, we can look at this chart. This is 5 market momentums here. And this is the moneyness. Out of money, near money, in the money. Eventually we found out that near the money is traded volume is the most. And then the OTM. Why is that? Near the money means that stock price is very close to the strike price. And out of money, so the speculators and traders like to take advantage of the S is almost equal to K. You can earn money. So you always trade a lot at TM. But in the extreme market, like when you trade market, you're very downward, you're very minus, right? Or is over 10% is upward market. The market is very volatile in these 3 streams. So there will be risk premium. So there are big risk premium here in these ends. So the implied volatility will be very high. Okay. And then we can find out another situation is that we can see the moneyness, see in the money, in the implied volatility and return in the market. We always see that ITM always have the highest implied volatility. Why is that? Midnight always have the highest value because ITM has the intrinsic value. Intrinsic value, right? You remember S minus K divided by K always bigger than 0.03. So implied volatility will be naturally high. And also another thing is that when you see the market conditions change, like when you see downward time, one is minus, downward, it's minus, returns minus. But its implied volatility is always over than the other market condition. Why is that? Because this is negative, right? Because the market or stock price fall down a lot, people will expect that it will go up. So people keep buying the stock price, which is very low, right? And then people buy. People expect it will swing up, so volatility is very high here, right? This is implied volatility. What is implied volatility? Is what people expect the stock price will go up and down. If implied volatility is very high, it means it has high value because it could go up very high, right? Then you can earn lots of money. We done another finding is that we found out that from 1990 to 2004. In this time, we have U.S. entered the recession, and there's a Gulf War. In Asia, there's Asian financial crisis, and so on. It's filled with negative news. So in this period of time, we have found out that egarch and egarch has the highest LLF, meaning not likely to go function. The higher LLF is, the better fit the model will be. So we eventually found out that egarch and egarch has the highest LLF, meaning that in this downward time, in this period of time that's filled with recession or bad news, the model fixed the recession, the bad time very well. So that's what we found out. Another thing is that we have another finding is that in terms of the moneyness, we can know that we use two measure MAE and IBIMSC to measure the error. Remember, the error is smaller, the more accurate the forecast will be, right? And we notice that egarch and tgarch always has the smallest error, right? Meaning that you can fully capture that, no matter it's OTM or ITM, you will fully capture. You will capture better than the other models. The same with the time to maturity. We can always see that egarch and tgarch have the smallest error, right? They're always the lowest line, the smaller error, right? Meaning that it's a very good model. So it should be, in this period of time, it should be filled with shocks and volatilities. And there are some symmetry in this case, I think. Even though it is not described here, but from this evidence, we know that there's shocks and volatilities in this situation. But look at that. Why does that error turn very big in this end? The reason is that as time goes by, they're filled with the Greeks and variables, and so they are big error. Error gets bigger and bigger because time goes longer, right? And so we can see that we still get the same thing that the egarch and egarch model. We know that it performs well. See, this is a different thing. This is bear market, right? That I said egarch perform good. The very small error. The egarch, because the bull market, the egarch perform well, right? So this is bear market, egarch good. Bull market, egarch is good. Yeah, like I have found out. So this is the conclusion we can come to is that this error that egarch perform well because it has small value, and also tgarch perform well has small value, right? Egarch and tgarch perform well, we have just found out. And the implied volatility And we know that egarch jump and perform well in volatile financial crisis. So RMFC is very small here. So we want to do some conclusions that option characteristics. We have found out we're doing still 6. So we have some conclusions here. So NTM is the most frequent trading. And OTM is preferred for hedging because of the low cost. And ITM option has the highest mid-quotes, spreads, and lowest percentage spreads. And we know that in implied volatility, meaning the value of the option, the higher ITM have highest than NTM and OTM. So match in the finding in last year as driven by skewness. So remember that in the ITM is that if the call price is 110, the strike price 100, then you have $10 profit. This is ITM. Okay. And also trading behavior by momentum. OTM demand is up when RM is low, while ITM trading is high with positive RM. Okay? So how do you use OTM to hedge? This for example, you buy a cheap good price 90, and the price drop to 80, and you earn $10, you can hedge your risk. If the price goes down, that's how you hedge the risk. Okay? And the model forecasting performance, egarch shows lowest MAE good, right? And IBM is very small. Garch and egarch also performs well. And egarch jump affected during volatility spikes. And so performance by moneyness and maturity, like better accuracy for higher moneyness and shorter maturities, and egarch excel in OTM, which is downward time. Egarch is strong in ITM, which is upward time. And then the accuracies is that when it's upward time, egarch, when it's downward time, egarch performs best. When it's upward time, egarch outperforms the others. And the egarch jump weakens in bullish trends. So that's what we found out. So bull and bear market, like that. In bear market, it's better to use egarch and egarch jump. In bull market, good upward market, egarch performs better. So in bear market, downward market, egarch and egarch jump. So performance in the event. So in crisis, before crisis, egarch is good. In crisis, also in post-crisis, egarch is also good. During the crisis, egarch jump performs well. And matching ID. So you know what to use. And forecast error by moneyness and time. So egarch is stable in short term, and egarch jump excels the high moneyness. Okay, accuracy declines with longer maturity. Just as I say, the longer the time, the more variables and risks you will encounter. Okay, so another VIX level model is that when high VIX means high panic, then meaning that volatility is higher, you use egarch and egarch. Good. Low VIX, low panic. In stable market, you use egarch, it's more accurate. But doesn't mean that panic, VIS equate to RM. They are not equal. They are different. And we have some summary, but I want to jump to the conclusion. How do we use it? So we use egarch and egarch in crisis, and use egarch in bull market. And we combine RM and VIX for best model. For the bullish, RM is greater than 0, and when VIX is low, and panic is low, we use egarch. When RM is smaller than 0, it's bear. When panic is moderate, we use egarch. And thank you very much. I release the curve.